Welcome to the Financial Pathway Podcast. We're here to help you go to the next level in your finances with practical advice from speaker and financial planner Nate Skelly.
So it is time for the monthly Money Minute Roundup. I've got 5 of my favorite articles that I found over the past month, ready to share them with you. Background's a little bit different today. I've got some new office decor. It's kind of blurry actually in the video, so you probably can't see it super well, but my wife got me some new wall art. Got Gandalf and Minas Tirith from my favorite series, The Lord of the Rings. So all the Lord of the Rings fans, I think you'll appreciate my new wall art. It's actually on the Facebook page. If you follow my Facebook page, I've got a better picture of it on there if you want to see it in all of its glory. But let's just go ahead and jump in today. I've got 5 articles. We're starting today with, do Vanguard and Blackrock secretly run the world? I'm a little bit sarcastic in my tone. In all seriousness, this is something that I've seen a lot of very serious, very smart people talking about here recently. And I think there's some misconceptions to clear up. I've even heard a lot of politicians talking about, the sinister nature of, that Vanguard and BlackRock basically own every major company. And so let's just kind of talk a little bit about what's going on here. Should we be concerned? Are there some serious issues here with Vanguard and BlackRock? As usual, one of my favorite blog article or blogs out there is Of Dollars and Data by Nick Majuli. It just seems like every article he comes out with is just phenomenal. But this is one that he wrote here recently. If you look up like Apple and Microsoft and just about every major stock in the US and just look at the list of the owners, who is the biggest owners by percentage of these major companies, you'll find Vanguard and you'll find BlackRock and you'll also find State Street, but hardly anybody's ever heard of State Street unless you're in finance. But they're another big one. And they're on every single list. And they're usually the top 3, like boom, 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 Vanguard, BlackRock, State Street. And you say, wait a second, what's up with that? Why do these companies own such a large portion? And in some cases, it's 6, 7, 8, 9% of the total value of these companies are owned by Vanguard or by BlackRock or by State Street. So what's going on here? Is this some type of conspiracy? Are these people, behind the scenes in shadowy cloaks running the American economy? Well, what's happening here is Vanguard and BlackRock and State Street are fund companies. They run mutual funds and ETFs that hold many, many different companies. So for instance, all 3 of these companies have S&P 500 index funds as an example. And the S&P 5 index is the 500 largest companies in the US, weighted by size. So for instance, Vanguard and BlackRock and State Street, all 3 of their S&P 500 index funds hold the exact same companies. And if you own an S&P 500 index fund, about 7% of that is in Apple, because Apple is the largest currently, as of this recording, the largest stock in the U.S. stock market. So it takes up a very large percentage of the S&P 500. So the idea is, if you or I own a share of Vanguard's S&P 500 index fund, 7% of our money is in Apple stock. But here's the thing. On the list of ownership, when you look up, who owns those shares of Apple, it doesn't show your name. It shows Vanguard's name because they're the ones who run the fund. There's no way that they can track who owns every single share of that Vanguard fund, but they know that it's run by Vanguard. So in essence, what's happening is when we see these headlines about, oh, wow, look at, 20% of this very large stock is owned by these 3 companies. What's going on? Do they have some sort of undue influence or something? Well, no, it's not really Vanguard or BlackRock or State Street owning these stocks. It's you and me and millions of others collectively owning those funds that are then invested in those stocks. Does that make sense? So that kind of takes the sting out of it, and it makes it, and then you realize, okay, it's not as sinister or as crazy as it sounds. One caveat to that, though, is those fund companies do what we call proxy voting. If you are a shareholder of a major company, and when they have their shareholder meetings, you as a shareholder can vote in proportion to the number of shares that you own. The problem with that is if you own $1 million of Apple stock, well, that's a lot of money. But compared to their $3 trillion market cap, that's a drop in the bucket. That makes virtually no difference at all. So even if you were to vote your shares, you're really not making a difference to the total tally because you own such a small portion, such a small sliver of the enormous pie that is Apple computers. So what Vanguard and BlackRock and State Street and pretty much every other fund company out there does is they do proxy voting. So, because think about it, if you own 500 companies inside one S&P 500 index fund, are you going to vote on every single one of those companies' shareholder meetings? Of course not. There's no way that you could do that. And that's just on one fund. Most people have several funds inside of their 401k or inside of their IRA. So you're really going to look up the meeting notes and the proposals for every single one of these publicly traded companies and vote your shares, and they're going to make no difference. No, of course not. So basically what happens is we outsource that to the fund company, and Vanguard and BlackRock and State Street and all these fund companies have guidelines. They have written policies and procedures in place for how they will do the proxy voting. So essentially what you're doing is you're outsourcing that voting power to that company. But in reality, you say, okay, well, what if they, had some sort of nefarious designs? What if they wanted to collude and, vote on these matters because they have such a large portion? Couldn't they sway votes? I suppose. But even if they were all to collude together, these big three, they're still only about 20% of the total voting block. And on top of that, when you look at their voting history, almost always they vote in accordance with management. And the times that they go against management, it's because it goes against their policies. Like, for instance, they may have a policy that if a board member has not shown up for at least 75% of board meetings, if that board member proposes something, they're not going to go along with it. So it's those types of things. So when you really look into it and get beyond the headlines, what you'll find is that there's not really something so sinister and dark going on. It's actually pretty normal and not as terrible as it seems. But it's really good. This has come up a couple times, and I think it's a good thing to highlight and make sure that people are aware of. Okay, moving on quickly now. Let's go to our next article. How does Apple, speaking of Apple, how do they catch their leakers? It's really interesting because Apple Computers has over the years developed a lot of like spycraft level techniques to figure out who's been leaking information to the press or to competitors. A lot of corporate espionage these days, and a $3 trillion company. I mean, Apple dwarfs many countries' GDPs just by themselves, like their economic output. So there's a lot at stake, both job-wise and money-wise for Apple. So they go to great lengths to protect their information, whether it's Apple Watch or the new iPhone or iPad, like or a new product development like the VR headset. They're very, very careful. And one thing that they do in order to protect that information is they often have people working in silos. So they have different departments, and they might have a person or a team of person working on one specific component for audio, but they don't even know if the audio is going to be for AirPods or for a computer or for an iPhone. They're just working on one very specific audio component. So that way they don't have any ability to sort of share or leak information about anything else in the project. So they kind of keep it segmented. But that's a very simple thing. There's some other kind of cooler and more movie-esque level things that they will do to figure out, okay, who's leaking information. So let's say some plans for their newest iPhone get leaked to some publication, and it's like, oh, hey, here's a sneak peek at the the design of the new iPhone. How do they figure out who sent out that information? Well, there's a few different things they do. Like, for instance, invisible watermarks. So like they can take a background that maybe it looks completely black, but they took 1 pixel in that entire background and changed it to a slightly, almost the same color as black, but a slightly different color. Then they'll be able to run that back and actually find which pixel was changed, and it's a different pixel for each person that they're sending out that information to. So it's basically undetectable if you're receiving that document or that information to know that that's in there. Another thing is they'll choose different file names. So they might send out, oh, hey, here's this picture, the latest renderings, and send it as a file, but they'll name each file name a different, they'll change up one number in the file name and have this long with many characters, so that if that surfaces again, they know exactly who got that file and who that was. Similarly, they might change even serial numbers or typeface. So they might send out like a press release or information, and they change the font sizes ever so slightly, or they change the font itself, or sometimes it's like not even the font itself, it's just the wording. It might be putting something in the present tense versus the past tense, or even commas or punctuations, periods, those types of things. So very, very interesting, all the different things that they go, the lengths that they go. And then, of course, finally, no spycraft would be incomplete without sending up false flags. Like, one thing that they'll do is they'll actually purposely leak false information and see if it comes out. So they'll maybe, if they've got 10 people that they're like, I'm not really sure if this person is on the level, they will send each of them a slightly different piece of false information and see if it surfaces somewhere. And of course, if it does, then they know exactly who the leaker is. So I guess the moral of the story is, if you work for Apple or any big company, don't leak information, because they're going to find you and they're going to get you, because they got really sophisticated techniques of figuring that out. All right, moving on now. This comes from Reader's Digest, one of my favorite publications as a kid. I don't know if you're like me. We used to get the Reader's Digest every month at our house, and I would always go right for the jokes section. But Reader's Digest is still out there, I guess, in digital form. I don't know if they'd send out the paper copies anymore or not. But this one is 50 tips to help save money on groceries, which I thought actually really, really helpful, because food prices have jumped so much, and it's such a huge part of everybody's budget. Man, if you can find a few ways to save save a few dollars on groceries, that can be very helpful. I'm not going to read you all 50. I'm just going to skip a rock over some of these, but some really good suggestions and tips in here. Very simple, starting with simple things like make a list. I found that if you go grocery shopping and you don't know exactly what it is that you want to get, you probably end up spending more. So make a list of the things that you want, even if it's the snacks and kind of extra stuff. Shop on Wednesdays was an interesting one. So apparently, stores are less crowded towards the middle of the week. Wednesdays tend to be the least crowded days. And it really does help, because when the grocery store is full and there's a lot of people in the aisles, you're a little bit more flustered, a little bit more distracted, and you don't pay as much attention. And so if you can go on a day when there's less people around, you can be a little bit more purposeful, and it actually helps. Pay attention to unit prices. Something that I found helpful is, you're looking at, peanut butter or whatever the product is, and there's so many different choices, and you're trying to figure out, and there's different sizes too, and you're trying to figure out what's the best deal here. Don't just look at the total cost, look at the unit price. What is it per ounce? Or, depending on what the product is and how it's divvied out, but look at the per unit price in order to compare side by side what is the best deal, because they always have that in smaller print underneath the main price. They'll put, oh, it's 17 cents an ounce for this versus this other one is 25 cents an ounce. Another one, I've said this many times, I'll say it again, don't go to the store hungry. This may seem like a super obvious one, but when you go shopping and you're hungry, you buy more stuff because everything sounds good. And you also tend to buy less healthy stuff too. So if you're going to go shopping, make sure you do it after you've had your breakfast or your lunch or a meal or a snack, so you can have more self-control. Also, even the cart that you choose. Like, if you're just going to the store for a quick couple things, grab the hand basket instead of the cart, because when you grab a bigger cart, you tend to want to fill it up more than if you're just going to grab a couple things. Another good tip that was in here was make sure that when you're shopping, you're looking at the top and the bottom of the shelves. Stores will purposely put their highest margin items at eye level, because they know that's just where we're naturally going to tend to look. Very often, the best bargains or the best prices are the stuff that's on the bottom shelf or at the top shelf, because we're just less likely to notice those things. Anyway, lots of great tips in there. Check out that article. If you get the Money Minute email, you can see all 50 of them. Some great tips in there for saving money on groceries. Moving on now to Social Security. If you are receiving Social Security every single year, there is a cost of living adjustment if appropriate. So because things are getting more expensive most years, year to year, things are getting more expensive. They will actually adjust your Social Security payment accordingly. They use the Consumer Price Index, which is the most common measurement of inflation. So for this year, well, I should say for next year, for 2025, the raise is 2.5%. That's basically what inflation has been for this year. Historically, inflation has been around 2 to 3%. It's actually hovered around 3% as a historical average. And so that the average Social Security check right now is $1,920 a month. That would rise by $48 to $1,968. There are some people that are pushing back on the way that Social Security is measuring inflation, because what they argue is that may be like in general for across the board in America, yeah, things might be 2.5% more expensive. But for senior citizens, that's not exactly accurate, because what they spend money on is a little bit different than the quote unquote average American, because healthcare costs hit senior citizens a lot harder than younger Americans, that they should use a different metric when figuring out that adjustment. A couple years ago, you may remember back in 2022, it jumped up almost 9% because inflation had spiked so high. But because inflation is now back at more of a historic level as far as rising at 2.5%, that's going to be the adjustment for next year. And then last article, I found this very interesting, just kind of underscores the importance of long-term investing and not trying to market time. This comes from Financial Advisor magazine. Bad timing cost fund investors 15% of their gains over the past decade. What they did is they did a study where they took all the different U.S. mutual funds and exchange-traded funds, which are the cousin of mutual funds. They work almost the exact same way. So these are just two different types of funds that people use for retirement savings. They took the total return of all of those funds together, which of course there's many different types that invest in very different things, but all those together on average earned 6.3% from 2014 to 2023. But the average investor earned 1.1% less than that, about 5.2% on that in that same time frame. You say, okay, how is that possible? If they're investing in those funds and those funds did 6.3%, how did the investors do worse? It's because of when they moved money in and out of those different funds. Because of course, some of those funds did better at certain seasons of time and some did worse than others. If you collectively just bought those funds and kept them from 10 years, of course you would get the exact same return. But if you're moving money into this fund now and then you take it out and then you move it over here later and back and forth, you may end up with a better or a worse return based on your timing. And what the study showed is that on average, US investors did a lot worse. Why is that? Well, because at certain times, investors were moving their money maybe into more conservative investments, more aggressive investments, tech stocks or energy stocks or finance stocks, depending on their feel or their conviction about what was about to happen next in the market. And probably most of this occurred in 2020 and in 2022, because those were the two down years in the market. And especially in 2020, a lot of people made some pretty significant changes with their investments because, hey, COVID, we don't know what's happening here. The world is shutting down, and this is a pandemic, the likes of which we've never seen. And so there was a lot of, and of course, the market dropped very, very quickly. And when investors start to move money at different times based on their feeling about where the market is going, very often that leads to underperformance over time. And this is not the only study. There are many, many studies from different time frames that basically all end up showing the same thing. You got to be very, very careful about making changes to your investment strategy based on short-term news. And so I found that very interesting. Again, this is the one in a list of one study in a long list of studies that continues to show that market timing and investment performance suffers when you are more active with moving money around. So that 15% of gains means, okay, what you would have got if you just kept your money in the US mutual funds and ETFs and just held that for the long term versus moving in and out, you ended up with 15% less money over those 10 years. Okay, last thing, as always, I'll mention the Money Minute email. If you're not on that list, you can go to nateskelly.com, get those emails in your inbox every month, see the interesting articles that I put together each month, and some posts from the Facebook page as well, just popular posts over the last month. So thanks as always for listening, for watching. If you're on YouTube, please subscribe to our page there. We're going to be doing more YouTube content in the days ahead, and we'll see you on the next episode.